Let's take a look at Skulas Inc., a snowboard manufacturer gearing up for January 2018. Picture this. The CEO plans to sell 2,900 Pipex snowboards at $650 each, starting the year with 500 boards in stock and aiming to end January with 200. Every aspect, from manufacturing overhead, $7 per labor hour and $81,000 fixed, to marketing costs at $250 per sales visit, is carefully forecasted. They even use FIFO inventory methods, ensuring accuracy in tracking costs and inventory. This detailed approach sets the foundation for understanding how smart financial planning keeps a business on track. Now let's break down what it takes to build a snowboard. For every Pipex board, Skulas needs 9 board feet of wood and 10 yards of fiberglass, plus 5 hours of direct labor. But planning doesn't stop there. They also track how much wood and fiberglass they'll have at the start and end of the month, ensuring no material shortages halt production. Prices can shift. Wood jumps from $32 to $34 per board foot in 2018, and fiberglass rises too. Even labor costs increase by $1 an hour, reminding us that budgeting means staying ahead of changing costs. First, let us build operating budgets. We always start with the revenue forecasts first in Schedule 1. Based on the sales number, we decide the units to be produced in Schedule 2. For January, Skulas expects to earn a whopping $1,885,000 from selling 2,900 snowboards. But how many should they actually produce? By adding the desired ending inventory and subtracting what's already in stock, they calculate a need to manufacture 2,600 new boards. This isn't just number crunching, it's about making sure they meet demand without overproducing. Think of it like meal prepping. You plan just enough for the week so nothing goes to waste. Schedule 3A forecasts how many direct materials are going to be consumed for production. Skulas calculates exactly how much wood and fiberglass they'll use. 23,400 board feet of wood and 26,000 yards of fiberglass for January's production. Schedule 3B budgets for what must be purchased, accounting for beginning inventories and what needs to be left over. Note that Schedule 3A results are used in Schedule 3B. By adding the desired ending inventory and product on usage and subtracting what's already in stock, they calculate a need to purchase. This has to be done for both units and dollar amounts. Moving on to direct labor costs in Schedule 4 and overhead in Schedule 5, every snowboard requires 5 hours of direct manufacturing labor, totaling 13,000 hours for January. At $29 per hour, that's $377 just for wages. Overhead costs add another $172,000, covering everything from utilities to equipment maintenance. By dividing total overhead by total labor hours, the overhead allocation base, Skulas finds an allocation rate of $13.23 per hour, translating to $66.05 overhead per snowboard. This careful breakdown ensures each board's true cost is crystal clear. Finally, let's see how all these pieces come together in Schedule 6A. Skulas calculates that each finished snowboard costs $607 to make, combining materials, labor, and overhead. Using the unit costs, it can calculate ending finished goods inventory in Schedule 6B. For inventory accounts at month's end, they'll have wood worth $52,360, fiberglass at $18,360, and finished snowboards valued at $121,400. Altogether, total ending inventory stands at $192,120. Schedule 7 is the cost of goods sold budget for January 2018. It starts with finished goods inventory, adds up direct materials, labor, and overhead, then subtracts ending inventory to reveal a cost of goods sold of $1,639,480. All these feed directly into the budgeted income statement, where revenues of $1,085,000 minus costs yield a gross margin, and after accounting for operating costs, an operating income of $201,020. Each figure connects back to earlier schedules, showing how detailed planning leads to a clear financial picture. Now let's look at cash budgeting, essential for keeping a business running smoothly. Skulas lists expected balances at January's end. Property, plant, and equipment is valued at $175,600 and long-term liabilities at $182,000. Notice several items are left blank, like cash and accounts receivable. Why? These values depend on the month's activities and will be filled in after crunching the numbers from earlier schedules. The section also shows December's starting points: $124,000 cash balance, $1,650,000 in budgeted sales, and $820,000 in material purchases. This context sets up our next calculations. Understanding when money comes in or goes out is just as important as knowing how much. Skulas expects to collect 40% of invoices in the same month and the rest the next month, a common pattern for many businesses. For purchases like direct materials, half is paid right away and half a month later. Fixed overhead includes non-cash expenses like depreciation, so not all costs mean immediate cash outflow. Also, equipment bought on credit doesn't reduce cash now. Lastly, remember the planned $160,000 dividend. Big outflows like this need to be anticipated. All these details shape Skulas' actual cash flow each month. Let's break down Skulas' cash budget step by step. First, cash collections from sales, $990,000 from December invoices and $750,000 from January sales, add up to $1,744,000 coming in. Next, cash disbursements for material purchases, half from last December, for half from January, $500,800, totaling $920,800 going out. Finally, fixed overhead costs. Only the portion that requires actual payment counts toward cash outflows, $17,000 for manufacturing and $25,000 for non-manufacturing overheads. This careful separation ensures Skulas can predict its real cash position accurately. Now we see the big picture for January's cash flow. Skulas starts with $124,000 in the bank and adds $1,744,000 from receivables for a total of $1,868,000 available. Outflows include material purchases, $928,800, labor, $377, manufacturing and marketing costs, $91,000 plus $9,500, fixed overheads, $17,000 plus $25,000, and a $160,000 dividend payout, adding up to $1,600,300 spent. Note that we take out depreciations from manufacturing and marketing costs and fixed overheads because they are not cash outflows. After all these payments, Skulas ends January with a healthy cash balance of $267,700. Tracking inflows and outflows like this helps any business avoid surprises. Wrapping it all up is Skulas' budgeted balance sheet for January's end. A snapshot of financial health. Cash stands at $267,700, accounts receivable is $1,131,000, inventory is valued at $192,120, and property and equipment totals $175,600. Liabilities include accounts payable at $510,800 and long-term liabilities at $182,000. Stockholders' equity fills in at $2,073,620 so that assets match liabilities plus equity at $2,766,420. This final schedule ties together every detail from earlier budgets, proving how each piece builds toward a complete financial story. Cash cannot be below zero, so if cash is negative based on cash budget, the company will need to borrow to balance the book.